Weekly rebalance.
Welcome back. The time to rebalance. Should it be
There
our
you go.
tagline?
Rebalancing time. You've drifted long enough.
Yes. Can't let that happen anymore.
Exactly.
Oh boy. Well, what do you think about the last week or so, Nick?
Yeah, been some interesting times. I don't know. Again, and I think we talked about this on our last call where we were talking about, taking a look at overall index returns and then comparing that with the underlying sector movement. And particularly last week, seeing overall broad indices down pretty much across the board, but underlying sector movement, actually, if you're just taking a look at the number of sectors being positive, more sectors positive than not. Obviously, when you factor in market cap, that wasn't necessarily the case, but kind of like some similar stuff going on this week. So I've been watching that.
Yeah, yeah, absolutely. I was particularly interested in just pulling up some recent economic data and kind of comparing and contrasting. But one of the things that was really interesting to me was, and I'll share my screen here so you can see this. I know we talked about this already, but as I was organizing for this week, I think, there's obviously been some positive and some negative economic data coming in. I don't know. One thing that's interesting to me is these revision numbers. So like PPI got revised in an extreme way uh this last release from the August data. I mean, 40 basis points. I mean, that's a lot. It's very hard to measure the impact, um, or just make an assessment of it when you look at that. Because one of the things that I like to look at is how is the relationship between PPI and CPI interacting? If you're getting an acceleration in PPI at a faster rate than an acceleration in CPI, that to me means that the gap is being taken out of company bottom lines. I love to watch that, and that is something that it's hard to, you know, make any sense when you have 40 basis points of revisions. It just questions the accuracy of the data. And, eventually I presume that it will be accurate, and maybe this revised number is accurate, but I mean that's just a big number from my perspective to have that a 40 basis point revision. To me, that was way out of line and surprising.
Yeah, agreed. It was definitely surprising. I guess in one sense surprising, and in another not so surprising, because just given what we were expecting, given the tariffs were likely going to hit Q3
Yeah,
throughout Q4, seeing those initial PPI numbers was kind of a surprise
yeah,
at the time. So I think they had a decent amount of suspicion around those numbers, and then revisions kind of brought
yeah,
that more into line with expectations. But I definitely agree. It makes things very difficult.
right, right.
Not that estimating those numbers is necessarily an easy thing, but
Yeah, it's not
either.
any easier.
But definitely makes things from our perspective a little bit more tricky.
Yeah. I know that's something that we both have paid attention to over the past. What do you, because 1 month, that's the other thing. 1 month of data is just, not much to go on. But what type of trend do you find relevant in that space when you're looking at the comparison between the two different inflation metrics there? You think is 3 months a trend? Is 6 months a trend? Is a year a trend? What in your opinion is most valuable, or where you'd start to pay really close attention and potentially make portfolio changes because of it?
Yeah, I don't know. That's a tough one. I think it really depends on the context. Not to cop out on your question there, but
Yeah.
you know, we were kind of expecting this to play out with PPI, CPI here, especially Q3, Q4. So given that our suspicions are kind of being confirmed by these numbers and how they're actually coming out, um, even though what is this the second month in a row? I can't remember off the top of my head.
I
Is it
think you're
two
right.
or
I think
three?
that's
Yes, I've 2 months in a row But given that we already kind of had that suspicion, we've got these fundamental changes in the market that are going on. I mean, like I'm already kind of paying pretty close attention to it as I see it kind of developing a trend that we would expect to continue, or at least the relationship change in a way where companies either protect their margins or they just have to eat it. And I
Right.
think that's really the question that we're watching is, does CPI catch up with PPI at this point, or does CPI reflect that change? And that's a huge question for margins for these companies. So I don't know. In terms of looking for a trend, I would say once you have 3 months, you got something to look at. But with this one, we were kind of anticipating that before even the first PPI print came in, that started to show this kind of relationship. So um, this one we've been on top of.
Yeah, 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 exactly. Well, and at the end of the day, the Fed, even, the two big competing, sides of the coin are, one side is you got labor market weakening, and the other side risk of inflation accelerating. But at the end of the day, the Fed lowered interest rates 25 basis points on the 17th. So, yeah, that is, I think that's one of the things, like, we were looking at our fixed income portfolio, and I think that's, one of the things that, if we make any major portfolio changes in the second half of this year, that we make changes to the fixed income portfolio, not the equities. We've already positioned ourselves, in my opinion, where we want to be, with a neutral stance on international, and just broadly diversified across the board. But we're taking on a little bit of extra duration risk at the moment, which has been good for us this year. But we're starting to see that yield curve shift around. What are your I don't know, what are some of the things that you're, I guess, concerned about or interested in, that might prompt changes from your perspective in the fixed income side of things?
Yeah, I think broadly speaking, we're expecting some bullish steepening. So just reduction in yields on the short end of the curve. And you and I have talked about this a lot. What are we expecting from the long end, especially the really long end, 30-year, 20-year, that sort of area. Um, and those are the really interesting points to watch, because I think, taking a look at the dot plot, Fed futures, pricing in the next few cuts, that sort of thing. It seems like we're already on a pretty well-determined path on the short end, or at least the very short end. Which is, we're in a cutting cycle, so we're expecting yields to come down on the very short end. But the thing that's a little bit less defined, and I think presents some risk with, well, at least duration risk, is on the far end of the curve. Do we see things start to creep up a little bit? We've seen yields come down on the 30-year, like you see here over the past month. Looks like we've came down about 20 basis points on the yield for the 30-year.
Yeah.
So we've seen some reduction in the 30-year, but that being said, as we move further and further out along the curve, it becomes increasingly dictated by growth expectations in the US and inflation expectations. And with the economy, we're not going into a recession. Inflation is relatively hot still. I mean, we're not at 2%. Fed doesn't expect us to
Above the
hit
Fed
2%.
target. Yeah,
Yeah, the supposed target. I
yeah.
think they said they don't expect to hit 2% until 2028. That's like one of the, I think Powell quoted that.
Yeah.
I could be wrong, but so we've got a little ways to get back to that. So I think there's a possibility that inflation becomes, or continues to be difficult to manage, especially in the cutting cycle, and that 30-year either doesn't come down as much as people are expecting, and maybe it also creeps up in certain ways. I mean, I think the interesting thing to watch, and it was one of the things I was looking for when the last Fed meeting, was watching the 30-year rate and see what it does. And at certain parts of the meeting, it was down a little bit, but ended up at the end of the day being up a decent little amount,
Yeah.
um, which is kind of what we were expecting. That tends to happen with Fed announcements. That's happened in the past, but given the environment we're in, it's kind of what we've been expecting. So I don't think we see yields come down on the long end of the curve as much, at the very least. But yeah,
Yeah.
what do you think?
I agree. I think that, one interesting thing that's investors are going to have to contend with and advisors are going to have to help them through over the coming months and maybe really the coming years as the the Fed uh, targets a much lower um, interest rate policy on the short end is people that have been used, it's funny, like investors, they don't think in terms of real returns, right? They forget about inflation. But they've been used to getting a nominal return of 5+%, 4+% for several years now, really, multiple years in a row, after a period of 0% interest rates. And it's funny how fast the norm can all of a sudden be reestablished and everyone's used to getting 5% in money market and short-term treasuries with no risk. And now that's going away. So it's going to force some investors to rethink what they do with the short duration, low risk investments. It'll be interesting to see where that flows. I think that's something that is a conversation that's important to have now with those investors because it's already disappearing, right? I mean, we're talking about we're down at 4.1% the yield looking at that. That's the treasury yield curve for 1 month. Obviously, the rate is now set at 4.25. So, I mean, that's a whole percent lower than where we were, what, not that long ago. So that's definitely something that investors and advisors are going to have to contend with and think through. But you're right. I think on the long end, I think the thing that I think of, and we were talking about this in detail yesterday, but the thing I think there, because the common complaint or concern that I see a lot of people raise is just the cost of a mortgage, and which is directly affected by the what we're talking about here. And I do hope it comes down because the inventory is very low. I was listening. I don't have the numbers or the data to verify this, but I trust my source, I guess, so that was assessing where inventory levels were, and the source was basically saying that they're at a 50 to 60 year low in terms of inventory. So inventories are very low, um, and the cost to buy is very high. But I hope that changes for investors so that it makes it easier to buy homes. Because basically, if you own a home already, you're in great shape. If not, then homes are very expensive and it's expensive to borrow. And I think that's one of the forgotten things in here is a lot of that expensiveness to borrow is the fact that mortgage rates are extremely high relative to where they were back in the, COVID days or 2020, 2021. But, you know, I don't know that necessarily just happens if the Fed lowers interest rates, right? I mean, that's something that I think people is a misconception from a lot of retail investors is that the Fed's lowering interest rates, my cost for a mortgage is going to go down. And maybe it will, right? Maybe it will, but it's definitely not guaranteed. It should lower the interest rate for maybe for auto loans, short-term loans, personal loans, that kind of stuff. But mortgage rates are still potentially at risk to stay elevated for a while. But it does put you into an interesting perspective or an interesting position with low inventories and high mortgage costs. You were mentioning something basically comparing this to a backwardation situation yesterday, which is kind of true. And I wondered if you wouldn't mind unpacking that a little bit. I know backwardation is probably not the most common term for every person, but I think it'll make sense in this real estate analogy to use that term and kind of talk through it a little bit.
Yeah, I think that is an interesting thing. It really kind of close to the page on this one because we bought a house last year, and so we were doing a lot of research on this, and I was doing a lot of thinking on it. But um, basically, there's this uh, part of the markets, especially typically you discuss this in futures or forward contracts, but basically when you're looking at commodities or even you can have currencies as well, but pretty much anything that you can trade on a forward or futures market. You can either have markets moving in contango or you can have them in backwardation. When markets are in contango, the futures price is higher than the spot price. And then when you have markets in backwardation, the futures price is actually lower than the spot price. And typically you would expect markets to be in contango, just given that, there's a time value of money. You can borrow the money and buy it today. Or in the case of really the way that you figure it out in most cases is you take the future price and you could discount it back at the risk-free rate or whatever discount rate you want to the current spot price today. So that's more of the typical market setup. And I say typical in quotation marks is
In
markets in contango.
the futures market, to simplify it, you're talking about delivery of some product in the future.
Yeah.
Right.
Yeah.
Yeah.
Exactly.
Whatever it is. So commodities markets is common, but drawing the analogy here to the housing market, when you're talking about a home build, which is what we're kind of getting into here, if you go buy a house today to be built, you're talking about something that'll be delivered to you in 9 months from now or 12 months from now or whatever.
Yeah, exactly. And typically what you see when markets, or one of the things that can push markets into backwardation is that there's scarcity in the market for that commodity or asset. So if there's a scarcity of, I don't know, let's say it's like cocoa or something like that, and you're a
Yeah.
candy bar manufacturer and you need to get some cocoa right away to make your candy bars. Because of that scarcity in the market, you can drive up spot prices, and cocoa today may be worth more than cocoa 2 months from now or something
Pay
like
a
that.
premium for the current, basically being able to get something today.
Exactly. So you can actually have futures prices go below spot prices. And I think we see kind of that playing out in the housing market a little bit, because at least when I was looking, um, locking in where they're going to build you a house. And part of this is like the difference in you're buying somebody's residence versus you're buying from a company that's manufacturing these houses. They bought the lots and everything, and it's all tied in to get together. So it's not necessarily the same thing, but I think part of what's going on is there's scarcity in the market. So if you have to wait 6, 7 months, maybe even a year to get your house, that's not the same as being able to get it and live in it today.
Right.
So I think we do see a little bit of backwardation in the housing market. And I think there's a few things that contribute to that, but one of them potentially is scarcity in the market.
Yeah, the low inventory. Yeah, and that's super evident. I mean, I think most could even, you don't even need to necessarily have the data to verify that. Anybody who's scrolled through Zillow or any of those other sites looking at listings, or just heard anyway talk about how hard it is to find a house. If you're looking for existing price, or even looking for lots recently, like I've been looking at lots recently, just kind of curious what it would look like to buy a lot maybe further out in the country. And there's not a lot of inventory available. There's not a lot. And then again, nobody's making any more land, but you can find dozens of developments around you where they've turned this farm into a 200 home, neighborhood now. And they're really nice houses, but you can tell that they're able to discount, like you said, everything's rolled in together. They're buying this property, developing it, splitting it up into half-acre lots or 4/10 of an acre lots or whatever. And then they're able to bring in this economies of scale, which is bringing down the price. That's the way they're basically manufacturing homes, and it is from what I have seen at the moment, it's a cheaper way to go than buying a home, because everyone is refinanced at or purchased at 3%, 3.5%, something like that, maybe even lower. Some people in the 2% ranges, and they're not just flooding the market with inventory. I mean, a lot of the inventory that I have seen come into play is needs a lot of work. It's not really, so you end up paying a little bit of a premium to be able to get that access to that home today. And then you pay a premium for basically having to do a renovation because it's not up to date and not modern. So yeah, it's an interesting market, but I mean, I hope that just that beyond the investor side of things here, just the hope is that it becomes easier for people to buy homes, that there be, the inventory problem will eventually get fixed by these home manufacturers like Pulte and Ryan and all these other groups that are now trying to flood the market with new inventory that's desperately needed. But we are in an interesting scenario where there's an incentive actually right now, depending on the market, right? Every market is slightly different, but a lot of markets across the country, I think, are experiencing exactly what you and I are referencing here, which is this kind of the future price of a home, the forward price, the futures price, if you want to equate it to the like commodities market, is actually lower for home delivery in the future from a builder than it is to go out and buy currently because inventory is so low. And that's especially like a lot of people don't have the luxury to build and wait, right? Like think about if you get a job and you relocate from Cleveland to Chicago or Chicago to wherever, Kansas City, you don't necessarily have 8 months, 9 months, a year to wait for your home to be built. So again, you're seeing all that kind of play out right now. It's just an expensive time for home purchases, especially because that's in place. Plus, mortgage rates are still very expensive at the moment. So, yeah, we'll see how that directly affects it's connected to the what happens in the treasury yield curve here as well, which again, I think there's a risk that it stays elevated on the latter half of the longer term borrowings. I think it's definitely something to keep an eye on, and probably the thing that we continue to talk about here over the coming weeks and months into the last part of the year, because I think that really is and I think in fixed income, by the way, that's one of the places where as a manager, it's worth having a good professional manager in the fixed income side of things. I think you could easily just take the market on the equity side of things. Not saying that that's what everybody should do, right? Not that some people love doing that, some people don't love doing that, but I think especially in fixed income that you can affect a lot of value if you know what you're doing in the fixed income markets. I think they're a lot less efficient than equity markets, just because most people don't understand fixed income markets the way that they understand equity markets. So, anyways, we'll be paying close attention to that, but definitely the last part of this year.
Yeah, absolutely. Absolutely. I think the other interesting thing too to note in fixed income markets specifically, in terms of short end of the curve yield replacement, because we've gotten a few clients calling in asking about where to park some money for 3 months, 3 months to a year. We've had a few of those come in recently, and it's just not the straightforward answer of let's buy a treasury that matches that cash flow that you have coming up or anything like that, because the yield is continually coming down. It's not a no-brainer like before. We could get 5.5%, I think, even at some points in a treasury.
Yeah.
So we don't have access to that anymore. And when you look at like a safe investment that's going to give you some sort of yield in the meantime while you're waiting for some sort of cash flow to go out, even if you take a look at like high credit quality investment grade corporate bonds, on the short end of the curve, especially, like the spread is very small,
Yeah.
like minimal.
Yeah.
So you're kind of stuck on that short end of the curve because you know a credit spread's not enough, at least in a lot of cases, in my opinion, to really warrant the additional risk.
Yeah. No, I
If you're
agree.
getting 10 basis points more in yield for an Altria bond versus a US Treasury, like,
Yeah.
sure, you're going to get the yield, and I don't think Altria is going to go under in 3 months by any means. But I mean, you are taking on an additional risk. There's no
Yeah.
doubt. So, and that really small increase in yield in some cases can potentially not be worth it, especially if they might have to have that cash flow a little bit sooner than the date that they give you, given that corporate bonds typically have even less liquidity than treasuries right before maturity. So,
Right.
um, yeah, it's tough.
Yeah, definitely. Definitely some investors have some decisions to make on how they want to handle that. So I think that one option is just almost the best option. I mean, obviously, if you need the cash liquid, you need the cash liquid. You just don't get the yield anymore. But for those investors that that's not the case, and they're just conservative. I mean, the easy and this is easier said than done, I guess, but it is they have to take on more risk. And a diversified bond portfolio is probably the way to go. But it involves, again, taking on more risk, which a lot of investors may not have that appetite. But again, you're having to pick. You're either having to pick between I'm just going to accept this lower yield, or I'm going to take on some more risk. So
Absolutely. And then you even get a further complication of that in the sense of, would you do money market or would you lock in a rate with a treasury? Because I
yeah,
think, we've had a few of those come up recently, and it's really a question of how long do you need the cash for? How certain are you that the cash flow is actually going to be on the date that you're telling me? Um, because right now the money market will give you a little bit more than the treasury. They're doing commercial paper, a few other things to increase that yield a little bit. And you have the additional liquidity, and you get the FDIC insurance and everything like that. But
yeah,
that yield's going to go down at the next Fed cut.
yeah,
You're going to see that right away. So,
yeah, absolutely. Interesting times. Well, more to come in the fixed income markets in the coming weeks and months for sure.
absolutely.
All right. I don't have anything else for today. You have anything else that you wanted to cover, Nick?
Nope, that's going to be it for me.
All right. Sounds good. Well, that'll wrap it up for this week. So we'll be back next week, same time.
All right. Bye, everyone.
Thanks, Nick.